Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of all the corporate gobbledygook out there. Today we're diving into Pursuit Attractions and Hospitality's proxy statement. Now, I know what you're thinking. A proxy statement sounds boring, but trust me, this document is like a treasure map, except instead of gold, we're hunting for juicy details about who's running the show and how they're getting paid, and other information that could move stocks. This report is dated April 9, 2025, and it's all about what's going to happen at their annual meeting. They want you, a shareholder, to vote on some important things. This meeting is scheduled for May 22, 2025, because it's virtual. You can attend from anywhere. The first thing they want you to vote on is electing directors to the board. Think of the board of directors as the company's oversight committee. We're talking about electing 3 Class 3 directors, folks named David W. Barry, Beverly K. Carmichael, and Denise M. Cole to serve until 2028. Also, they're trying to elect Brian P. Cassidy as Class 2 director and Jill H. Bright as Class I director. It's important because these are the people who will be guiding the company for the next few years. The chairman of the board is Joshua Schechter. David Barry is the president and CEO. The board has 7 directors. The company needs your vote to decide who will be sitting on the board. The report states that for as long as a certain group of shareholders called C parties have a large amount of the company's stock, they get to pick some of the people who are nominated to be on the board. Jill Bright and Brian Cassidy are their picks. The board says that to be a director, you need to be committed to the long-term interests of shareholders, have the highest ethical standards, and be loyal to driving the company's success. Let's take a quick detour to meet the executive team, starting with the CFO, Michael Bauheitz, a pretty new addition, named into the role in March of 2025. Catherine Tang is the Chief Legal Officer and Corporate Secretary and has a bunch of experience at big companies like Krispy Kreme and Yum brands. Leslie Stridle is the Chief Accounting Officer, who, by the way, will be stepping down from her role in June. Pursuit is all about good corporate governance. Think of it as being a well-behaved company. The company wants to follow some pretty simple steps for success. They want independent people watching over the company. The board needs to be effective with a mix of experience and new ideas. Shareholders get rights, like voting on important stuff, and the company follows good governance practices. So no one is doing shady stuff with their stocks. If you have something to say to the board, you can write to the corporate secretary at their Denver office. They say that all appropriate messages make it to the intended recipients. Let's talk about how the non-employee directors get paid. First, there's an annual retainer, which is like a base salary of $65,000. If you're the chairman of a committee like the audit committee, you get an extra fee. And if you are the independent chairman, you make an extra $100,000. In addition to cash, they also get stock grants valued at $25,000 each year. For example, looking at some director compensations, Ms. Carmichael made $100,000 in fees and around $125,000 in stock awards. Mr. Dozer, who has since departed, made over $300,000, a substantial amount. Here's where things get interesting because we see who actually owns Pursuit. Crespi Partners IVGP and its affiliated entities are the largest with over 6 million shares. BlackRock Inc. comes in second at over 3 million shares, and then River Road Asset Management, LLC, and Victory Capital Management Inc. follow behind. The filing says everyone has complied with share reporting rules except one late form caused by an administrative hiccup. Let's move on to executive pay. Jill Bright, Beverly Carmichael, Brian Cassidy, and Denise Cole have looked at all the details and think it's fair. Basically, it says we've checked it and we're good with it. Time to dig into the paychecks of the top executives. These are the folks who make the big decisions, so their compensation is worth a closer look. Dotsushing explains how the company paid its top executives in 2024, focusing on why they got paid what they did. The company says its goal is to pay executives in a way that makes them want to increase the value of the company for the shareholders. That means rewarding them when the company does well, and not so much when it doesn't. 2024 was an important year for Pursuit. They sold off one of their business segments, GES, to focus on attractions and hospitality, which is their sweet spot. The company changed its name from Viad to Pursuit Attractions and Hospitality to reflect this new direction. The main business delivered solid financial results. The sale of GES created an opportunity for Pursuit to focus on what it does best, providing unforgettable experiences in amazing places. The Human Resources Committee made some key decisions on how to pay the top executives. Most of the executives' pay is based on how well the company performs. The board says that this structure helps motivate the executives. First, we have salaries. Most NEOs got raises of around 4% due to cost of living. Barry, the president, didn't actually take his cost of living increase as salary. Instead, he took it as stock. The long-term plan is really about making sure executives are invested in the company's future success, and what better way than stock. The annual incentive plan rewarded financial performance and progress on strategic goals. Performance was judged on how well the company did with earnings and a margin, which is profit expressed as a percentage. Executives also got rewarded for archiving strategic objectives. The Human Resources Committee continued using performance stock units in the long-term incentive program. 70% of the long-term incentive is tied to how well Pursuit stock does compared to other companies in the Russell 2000 index. The rest are just based on staying with the company for a certain amount of time. Here's the mix. The previous CEO, most as compensation. Only 18% was base salary, with most of the rest tied to performance. Ms. Stridle, on the other hand, the chief accounting officer, had 51% of the compensation come from salary, but take this with a grain of salt. This is because the equity that some other executives get is worth more than the raw salary. For 2024, the important financial targets were around $197 million in earnings, and based on reaching that target, they determined payouts. Looking at legacy Pursuit, which is most of the existing company that continues on after selling off GES, their earnings margin was a bit underperforming, so no payout was given. However, Spiro segment did amazing at around $35 million in earnings. It did way more than its $29 million goal. There are 4 strategic targets: attracting talent, making the core business stronger, allocating capital smartly, and maximizing shareholder value. Barry hit all strategic objectives. In short, the report says that the Human Resources Committee thinks this all aligns with the strategy of paying for good performance. Here's what it looked like in real numbers. Moster, the CEO, got $937,000. Ellen Ingersoll got $284,800, and so on. In 2024, they gave out long-term incentive awards, mostly in the form of stock. The hope here is to get them thinking long-term about making the company successful. For example, Barry got $2 million worth of these awards. Besides the usual salary and bonuses, some executives get perks. Moster got a car. These payouts are sort of an insurance policy in case something unexpected happens. They might include things like severance, retirement plans, and other benefits. In connection with the sale of GS, both Mr. Lind and Stelmach got incentive cash awards in the million range. The board makes the call on executive pay. There's a committee that reviews everything and makes sure it's all above board. Plus, they've got outside experts giving advice. To figure out how much to pay, they look at similar companies like Vail Resorts and SeaWorld. The company can take back compensation if an executive does something wrong, like messing with the financials or violating the code of ethics. They don't want people getting rewarded for bad behavior. Executives and board members need to own a certain amount of Pursuit stock to align their interests with the shareholders. The CEO, for example, needs to own stock worth 5 times his salary. The HR committee is aware of tax deductibility limits on compensation, but reserves the right to exceed these limits if needed to retain key executives. Let's look at the actual pay numbers from 2024, 2023, and 2022. Moster, as the former CEO, got a total compensation of almost $7 million in 2024. Ingersoll also got a pretty impressive $233.20 gotten. That he got $3.7 million, Barry got $3.7 million. Ingersoll is receiving thousands in accumulated benefits. Let's take a look at the outstanding equity awards table. Barry, for example, held thousands of unvested stock units. Moster held about 300,000 stock options and unvested RSUs. This section explains what happens if an executive leaves the company. It covers scenarios like retirement, a change in control, or termination. If there's a change in control or termination, executives get certain payouts and stock options might vest early. It seems like Pursuit is betting big on its future by focusing on attractions and hospitality and tying executive pay to performance. They're trying to create a recipe for long-term success. One thing to consider is the high executive pay. While it's tied to performance, it also means a lot of money is riding on the decisions of a few people. Pursuit will need to deliver to justify those high payouts. Selling off GES allowed them to really narrow in on their focus on hospitality. Whether this will ultimately be good or bad is yet to be seen. Overall, Pursuit is at a crossroads. The sale of GES was a big move, and now it's all about execution in their core business. The future looks promising, but the company will need to stay nimble and adapt to the ever-changing tourism landscape. So thanks for tuning in to another episode of Corporate Decoder. Hit that like button if you found this helpful, subscribe for more deep dives into the world of corporate documents, and let me know in the comments if there are any other companies you'd like me to decode.